Hi, everyone. Okay, game plan for this discussion is to lecture you on the practice midterm for Chapter 10. We got a little bit backwards in how we looked at the information. Chapter 10 was supposed to be week 1, but we had Chapter 2, or week 2, Chapter 11 completed before we did week 1's Chapter 10 information. But this will complete the set of information that I plan to have up for Chapter 10 now, this discussion here. And the format will be, as I've said, slides, the lecture that go with the slides, the practice midterm, the lecture that goes with the practice midterm. And then as I'm going to do here, I'm going to make some calculations here on the Word file for what's now going to be our Chapter 10 practice midterm, and I'll post up the marked up version of the file, assuming the thing doesn't crash, because sometimes when you mark these up, Word has a little bit of trouble saving it for some reason. So if that happens, unfortunately, we won't have the markup, but hopefully that'll be the case. The way Wiley provides a test bank, which these practice midterms are coming from the test bank. I'm going to go back into the test bank when I prepare your actual midterm and pull similar questions from the test bank. So the way to study for the midterm is these practice midterms. The way Wiley prepares their test bank, they don't show the calculation for the answer. I don't know why they do that. I guess they want me, the instructor, to have to figure it all out for you. So I'll do the best I can to show you the way these are calculated by writing it all down as I go. Save that file and you'll have the markup as well. Okay, so we're going to go ahead and we're going to look at this midterm here. And what I did was I just went ahead and opened that already, so we don't have to wait for it to open. I'm going to put my machine in tablet mode, which always involves a tremendous amount of moving things around. Hang on with me, because Microsoft decided that this was the way things would work. Okay, and I just want to double check to make sure I'm still recording, which I am. Okay, good. So let's just go ahead and let's take a look at these questions from Chapter 10. Okay, so this is the Chapter 10 practice midterm. Okay, we're going to go through, I guess there's about 15 questions here that we'll go through together. Again, this is your best way to prepare for your midterms. I know that we have the homework as well. The homework in Wiley Plus is good extra practice. I do want you to look at that stuff. Don't sit there and lock in on that homework as much as this. Just sort of feel what's going on with that homework, and I'll give you the 1 point when you go in there and do that. Okay? Okay, good. So Chapter 10, remember we were talking about assets, and one of the key things we were trying to understand is, what is the difference between land versus building versus equipment. And remember, we said that any cost that we incur to secure the land, getting it nice and flat so we can begin building on it, is part of the cost of the land. Anything that we do to put something on top of the land, like land improvements, or anything we do to start so that we can have the building, which is going to be digging a hole for the foundation, and that's part of the cost of the building. So you have land improvements, things you put on top of the land, and then if you start digging a hole in that nice flat setup of the land that you had, that's part of the cost of the building. Okay, so let's take a look using that visual. Okay, hopefully that visual was helpful for you. Wilson Company purchased land as a factory site for $1,350,000. Well, look, if that's what they paid for the land, that's going to be the easiest thing in the world. $1,350,000. Wilson paid $120,000 to tear down 2 buildings on the land. Well, they're tearing down those buildings so that they can get it nice and flat to begin to build the new factory site in this case. So since that's part of the cost of getting that land ready to build that building on it, I've got to bring that in. Now they tell me that the salvage from the building was 8,100. So they sold, and remember, I think I give the silly example in our lecture for chapter 10. Oh yeah, there's some beautiful doors, some old-fashioned doors that we can sell to a door dealer or something. I don't know. Okay, so when you get proceeds in like that from selling scrap, that becomes a subtract off the cost of that land, right? Then what? Legal fees were paid for a title investigation, right? Make sure there's no liens or anything on that property. So we go ahead and we're going to add that because that's going to allow us to take the land free and clear of title. And then we also went ahead and paid some architect fees here. They tell us at 46,800, just reading through the question. No, we're not going to pick that up as part of the land. That's part of what? The building, right? The architectural drawings or whatever for the building. Insurance costs 3,600, and that's title insurance. So again, a title insurance basically is an amount the title company makes you pay. So if there is some problem with the title, it's on them to figure out how to work that out for you. So we got to pay some title insurance. Liability insurance during construction, no, that's part of the cost of the building for the construction. Excavation costs. Excavation means digging a hole for the building. Our visual helps us with that, so that's part of the cost of the building. And then they say the contractor was paid $4.2 million, the contractor to build the building, part of the cost of the building. An assessment was made by the city for pavement of $9,600. Well, what are they doing? We're having to pay the city to put, I guess, some pavement in front of the building. Paying the city for that assessment is part of the cost of the land. Now, that one's a little bit tricky. I don't think I would ask you something that, I don't know, jargonistic on your exam, okay? But it's worth noting that if you have to pay something like the cost of that assessment by the city, so then you can go ahead and make a land improvement, put the pavement up, that's part of the cost of the land, okay? And then they give me some information about interest costs during construction. That, of course, would be, capitalization of construction period interest. We'll get to that a little bit later, but that's not part of the cost of the land, okay? So we start to get in here, and we start to add all of this up. And I'm going to write the total here since I ran out of room. You add all these numbers up, that total comes to 1,480,320, the answer to this question. Okay, so you can expect some questions like that on your midterm. I probably won't get as, granular about something like this, but things that fit more into that visual of getting the land nice and flat versus digging the hole for the building is the nature of things I'd expect you to know. Okay, now same fact pattern, but now they want to know cost of building. And remember, this isn't just some silly accounting exercise. We really need to know what constitutes land versus land improvements versus building, because what land improvements and building are depreciated, whereas the land, of course, is not. Okay, so we start coming in, and those things that we counted up as the land, the salvage value, the legal fees, etc. So we really don't start hitting things that would constitute the building. This is the same fact pattern until we run into those architectural fees, right? Blueprints, drawings, all of that is part of the cost of the building here. Okay, liability insurance during construction, right? Yeah, we're going to pick that up because that's for the actual construction of the building, right? Okay, what else? The excavation cost. Yep, got to pick that up. Digging a hole for the building is part of, for the foundation of the building, is part of the cost of the building. 15.6. The contractor, yeah, that's a big number. Got to pick that up. 4,200,000, right, for the construction contract. And then we picked up the assessment for the pavement. That was part of the cost of the land. Interest cost, and they just go ahead and give us this number. Okay, we have to pick that 255,000 up, although they didn't really show us the tools we would need to calculate the amount of capitalized construction period interest, which we'll start dealing with a couple of those problems here in a second. But yeah, we do need to pick up the interest incurred during the construction, and so we take that 4,521,360. Okay, and that's choice D there, as you could probably see from the fact. At least they tell us what the correct answer is. They show us nothing on how to calculate that. Okay, all right, good. So now we start to look at this one, and here they want to know, well, what constitutes the cost of the land versus the cost of the building? So we're going to have to go through, and it's kind of like answering two questions in one here. So I'm just going to put land here, okay, and building here. Okay, and I'm just going to go ahead and grab the costs that go to each of these. So what happens? Well, we have on February 1st, 2020, Nelson Corporation purchased a parcel of land as a factory site for $320,000. So whatever you pay for that land outright is part of the cost of the land. Got to pick up that $320,000. That one's pretty easy. Architect fees, that goes where? That goes to the building, right? Okay. Legal fees for investigation and purchase contract, that basically is going to be those legal fees for the purchase, whatever. That's part of the purchase price of the land. Construction cost here are going to be $1,390,000. Sometimes the hard part is just lining these up for me. $1,390,000. That's part of the cost of the building. And then we've got the $10,000 for the scrap that was sold, and of course that $10,000 comes off the cost of the land. Okay, so when you go ahead and you add those two up for the land, we get $335,000. Okay, and these problems are a little bit nice to you in that you know, they give you just the one choice there that has a 335 for the land, and you're done. Okay, but you know, always go ahead and add these up when you're looking at things, just to make sure something unexpected hasn't come up to bite you. You add up the building. Yeah, D is the right answer. Okay. Okay, good. So let's go ahead then and let's look at this fourth one, Worthington, and they want to know what I should pick up as the cost of the equipment. Okay, well, any cost of the equipment, any cost that you have to pay to get that equipment so that it is up and working in your factory is part of the cost of that equipment. Okay, so Worthington Chandler Company purchased equipment for $40,000. You know, I got to pick that up. Sales tax, yeah, you got to pay the sales tax to get that equipment. Go ahead, try to go buy a piece of equipment sometime. Tell the person you're not going to buy it, pay the sales tax, and they're going to tell you, well, you ain't taking the property. Then got to pay the sale. You're not taking the equipment. Got to pay the sales tax. Other costs incurred with the freight, yeah, you can't install it in your business unless you pay the freight. Repairs of $350 for damages during the installation cost. And let me tell you, that's annoying. Okay, that's annoying. Repairs are generally expensed, okay? But no one's going to sit there and parse, oh, okay, well, $350 were for damage that we had to repair while we're installing it. You know, most companies are going to probably lump all of that in as part of the installation cost. This problem didn't want you to do that, because repairs, normal repairs, are generally expensed, right? But, you know, a repair that happens because you damage something while you're trying to install it, that's getting a little granular, wily, I got to tell you, okay? So they didn't want us to include that. I wouldn't give you something like that on the test. I think that's overly tricky, to be honest with you. I don't care for that, okay? Okay, good. So we've got to take that out, and then they tell us, or we don't include it, and then they tell us installation charges of $675. Okay, so I just want to double check my calculation here on this particular one. Remember, guys, God made calculator for accountants, right? Okay, so 40,000 plus 2,400, right? Plus what? plus 600 plus the 675, and they got to ignore that annoying thing there of the repairs during the construction, and that's going to give us 43,675. 43,675 going over to where the answers are revealed on the next page is going to give us option C here. Okay. All right, good. Again, nonsense like, repair while they're installing. I'm not going to get that silly. Okay. I do expect you to know, however, that a repair, a normal repair, say we've had this equipment for a while and then we have to do a normal repair like, change the spark plugs in a vehicle, that's expensed, whereas an extraordinary repair like changing the whole engine out is going to be capitalized. Okay? All right, good. Let's look at number 5 now. Messersmith Company is constructing a building. Construction began in 2020 and the building was completed 12/31 of 2020. Messersmith made payments to the construction company of $3 million on 7/1, 6.3 on 9/1, and $6 million on 12/31. Weighted average of accumulated expenditures were. Now, what's going on with this problem is I'm just asking you to calculate the weighted average of accumulated expenditure. But don't forget that weighted average accumulated expenditure for this question, it's an end in itself. From an accounting standpoint, it's not an end in itself, it's a means to an end. Once I've calculated the weighted average of accumulated expenditures, then I'm going to go ahead and apply an interest rate to that weighted average accumulated expenditure. That interest rate is the interest rate associated with the specific new borrowing for the construction of this asset. And again, remember, it's either an asset that I'm constructing for my own personal use in the company or as a unique item that I'm constructing, not for routinely manufactured inventory, for example, but for just an item that I'm constructing, like a cruise ship for Royal Caribbean or something. Yeah, I can capitalize the interest on money that I borrowed there. And the way I figure out the amount to capitalize is I take my weighted average of accumulated expenditures, I apply an interest rate to that, and the interest rate that I'll apply will always be the interest associated with the specific new borrowing. And then if I have weighted average of accumulated expenditure that are in excess of the specific borrowing for this project, then I'll have to use the average interest rate of all other borrowings of the companies for amounts that the weighted average of accumulated expenditure exceeds the amount of specific borrowing. That's the amount of interest that I potentially would capitalize, unless that amount of interest is more than the overall interest paid for the company for the year, in which case I would be capped at that overall interest. Okay? All right, that's the whole set of rules there for capitalization of construction period interest. This question is just saying, hey, can you calculate that weighted average of accumulated expenditure? Because that's obviously a vital part of being able to figure out how much interest to capitalize. Okay, so what happens? The rule is that the amount that you're going to capitalize is going to be predicated on the amount of time. The way you calculate the weighted average accumulated expenditure is the amount of time that expenditures were outstanding, and we do that on a fraction of the construction period. So we began construction in 2020. Okay, so we have what? We have payments that, and we completed on 12/31/2020. So we have payments of $3 million that were made on 7/1. So what happens? I take that $3 million, and since that was first made on 7/1 and construction ended on 12/31, that means that what was outstanding for 6/12 of the year, 12 months in a year. That's what? That's $1,500,000. When I do the math, okay, to come up with my weighted average of accumulated expenditure. Then what? Then I had 6/3 that was paid on 9/1. Okay, and if it's paid on 9/1, it's outstanding. They finished on 12/31, so it's outstanding for all of what, all of September, all of October, all of November, all of December. That's 4 months, right? So that's times 4 12s. Okay, that's going to give me 2,100,000. And then they had this amount that was spent on 12/31. Well, look, if construction ended on 12/31, then that was not outstanding at all during the year. So I take that 6 million times 0/12, right? Because that wasn't outstanding for any of the year, last day of the year, and that's how you do your weighted average accumulated expenditure calculation. You add that up. This is, remember guys, sometimes my zeros turn into sixes. Okay, so that's 2,100,000. That gives me what? 3,600,000, which is choice B. Good. Doesn't it feel good when you get one of the choices and it's right? Okay. Okay, good. Let's go ahead and let's take a look at this one now, and we're going to see that more of the same. They give me this expenditures. Okay, March 1st, 2020. Purchased land for an office site paying $2,700,000 cash. Newton began construction on the office building on March 1st. The following expenditures were incurred for construction. So we start on March 1st, and we have to look at this and, okay, here we go. We continue on, and they tell me the office was completed and ready for occupancy on July 1st to help pay for construction and purchase of land. And we have what, 3,600,000 that was basically to help pay for construction. We purchased 3 million, purchased land, 3 million, which, what am I looking at here, guys? Sorry, I'm getting a little bit confused. This question goes on quite a bit here, so let me move this up a little bit. Okay, so on March 1st, 2020, purchased land for an office site paying $2,700,000 cash. Newton began construction on the office building on March 1st, right? The following expenditures were incurred for construction. And so they go on and tell me that the office was completed and ready for occupancy July 1st to help for construction and purchase of land. 3,600,000 was borrowed. Oh, I see. On March 1st, on a 9% 3-year note payable. Other than the construction note, the only debt outstanding during 2020 was $1,500,000. 12% 6-year note payable, dated January 1st, 2020. The reason I was getting confused is I kind of had peeked at what the question wanted, and so the question wanted the weighted average of accumulated expenditures. And so, I was trying to figure out, well, why are they giving me all this? This is a distractor that is not necessary to be able to answer this question, okay? So what happens? We sit here and we look at this, and they spent $1,800,000, okay? And they spent that $1,800,000, and they spent it on March 1st. So that money was what? Outstanding for, and the $1,800,000 was outstanding for 4 months. And you look at it, you say, well, wait a minute, why is that not 9 months? It's 4 months because what? The construction stopped. Remember, you only look at your weighted average of accumulated expenditure. You only capitalize interest for periods that the construction is going on. And so if they spent that money March 1st, it's what? All of March, all of April, all of May, all of June, because it was ready July 1st. Okay, so you only are going to calculate your weighted average of accumulated expenditure. You're only going to capitalize interest for a period where the construction is actually going on. So construction wasn't going on for, whatever it is, 9 months of the year. It was going on for what? For 4 months of the year. So you have to take that times what? Times the 4 12ths, 1,800,000. Doing the math on that, that gives me 600,000, right? Okay, good. Then you go to the next one, and this problem starts to become pretty easy because then they just keep adding another month on. So April 1st means, and I'm going to count one more time, then I'm going to stop doing that, but it was all of April, all of May, and all of June since the building was ready July 1st, right? So that's what? 3/12 times, and that's 3/12 minus 2,520,000. Okay, and I do the math on that, and that's what, 630,000? Okay, and so on. May means it's all of May, all of June, 2/12 for the amount in May, 4,500,000. That's a 4, guys. Okay, and so that's 750,000. And then the amount they spent in June was only outstanding for that 1/12 of the year. What's 4.8, right? Just pick that number up. 4,800,000. No, I'm not lining these up real good, but that's all right. Okay, that goes with that. Multiply that out, and that's going to give me 400,000. Okay, and then when I add those guys all up, I'm just going to write it over here. I think it'll be a little easier for you to read. It's 2,000,003. Where do I want to write that? 2,380,000. Those are zeros. 2,380,000. Okay, all right, good. So the key thing there is, key takeaway from that example question is, hey, be careful. You only calculate your weighted average accumulated expenditures. You're only going to capitalize interest for periods in which the construction is actually ongoing. So for that year, since they finished in June, we have to, only count the months for which the construction had finished July 1st. We have to calculate the periods for when the construction is actually going on. Okay? Okay, good. Now, you come over to this next question now, and we have the question of non-monetary exchanges. Remember, with non-monetary exchange, what happens? Instead of going in and giving up a financial asset like cash or something for that particular asset, what am I doing? I'm going and I'm trading something like a fixed piece of equipment or a piece of land, right? So my property, plant, equipment, I'm trading those things for another fixed asset, property, plant, and equipment type of asset, right? Okay, now, in these transactions, often there's cash involved. Okay, so even though there'll be some cash involved, sometimes we call that cash boot, by the way. Since there may be boot cash involved, that's going to determine how I'm going to make my calculations. Okay, now, anytime you sell an asset, remember we said during the lecture, there will be a gain or loss. There will be a gain or loss anytime you sell an asset, or dispose of an asset, I should say. Anytime you dispose of an asset, there will be a gain or loss unless you get cash back equal to the book value of that asset, but that's unusual. So there'll almost always be a gain or loss on the sale of that asset. Or if you get something back of equal value, equal to your book value, then I guess there'd be no gain or loss. But in most questions, there's going to be a gain or loss. So the question is, what do I do with those losses? What do I do with those gains? Losses, you always recognize them, no matter what. I don't care if the transaction has commercial substance or lacks commercial substance. You will always recognize the entire loss. Always. Got to take the entire loss. We know that. Okay? Now, a transaction has commercial substance if the problem tells you the transaction has commercial substance, or the problem says that it is a result of the transaction, cash flows will change significantly. Okay? If the transaction has commercial substance, we know what to do with losses. Doesn't matter. Whether the transaction has commercial substance or not, got to take the loss. The gain, I will take the gain if the transaction has commercial substance. If the transaction lacks commercial substance and there's a gain, this is where I have to start remembering some rules that are a little more granular. Okay, so what happens? If the transaction has commercial substance and there's a gain, okay? And I am what? I am, there's cash involved, and the cash constitutes 25% or more of the total consideration. That's the cash in the numerator, cash in the denominator, plus the fair value of whatever other asset, equipment, whatever was involved in that transaction. If that fraction is 25% or more, again, I recognize the entire gain. It's when we get down to it being less than 25% that the rules get a little bit weird, and that then I have to do what? If I receive cash, then I can take the gain up to that percentage that is less than the 25%. If I am paying cash, or there's no cash involved in the transaction, and it's in that lower 25%, of course, if there's no cash involved in the transaction, it's obviously below 25%, no gain for the entity that is what? That is not receiving cash in that situation, okay? All right, that's the rules. Then the only other thing for these, and we're going to see this up in this next problem, we're going to have to go through really the entire set of rules to a large extent, although this one has commercial substance, so maybe not all the rules, but the only other thing is what is the amount that I should bring the new piece of equipment on, and it's what? It's always the book value of the assets surrendered plus any gain or minus any loss. Okay, that's everything we said. We went on quite a bit with the longer example during the lecture, but let's go ahead and see if we can figure out what we're supposed to do here. Now, when I peek down, the exchange has commercial substance, so I know I'm going to take all the gain or all the loss. So I look, and they tell me that the book value, the old machine had a cost of $465 and had a net book value of what? $355. The old machine has a fair value of $300,000. That's a loss of what? Of $55,000. And whether the transaction had commercial or substance or not, I know I have to take that entire loss. Okay, now, quick little test taking technique right here. Okay, just to help you out when you're taking your exam, you look and you know that's the loss. A has a shot of being the right answer because it's sitting there and it's showing you a loss of $55,000. So you know that's got a chance. You look at B, okay, and B here is not recognizing any loss at all. It cannot be the right answer. You always have to take the loss. You look at C, C got a shot because what? Because it's showing the loss of 55. You look at D, there's no loss there. It cannot be the right answer, okay? So even if you get confused on this question, say while you were taking the exam, you know, you can turn a 1 in 4 chance into a 50-50 chance just by realizing that you always have to take the loss, okay? But let's go ahead and now continue on with this thing and see if we can figure out the rest of this journal entry, okay? Now, I know that they're going to have to do what? They're going to have to get rid of the old equipment, and they're going to get rid of that old equipment, what? At its original cost. So I know I got to credit equipment for $465, okay? Now when I look at that other choice that I was giving a chance to, I am done with this question. I wouldn't have to go any further because notice they didn't credit the old equipment for its original cost of $465. So I'm done with this question at this point. Now I'm going to go ahead and go through the entire journal entry and how each number was calculated on it. But remember, I was numbering those things before, showing you, hey, you can kind of piece together the journal entry and know pretty quickly in these questions which one is the right answer, okay? Now what happens? They tell me in the question that they paid cash of 40, okay? So I'm good there, got that number, I got that number, okay? Then what? And this isn't exactly the order we did it, the way I was showing you in the when we were going through the lecture, but okay, this question's a little different than the way we were looking at some of the things in the lecture, because here they tell me that what? The old machine costs $465, and they tell me that it had a book value of $355. That's 110,000. So that must be the accumulated depreciation, right? Book value is 355, cost is 465. That means the accumulated depreciation gotta be 110. And then the hardest part of any of these, I guess, if you want to call it hard, is figuring out, well, what's the value of the new equipment, okay? And so the way you do that is you say, well, what was the book value? I'm going to write that down, book value of assets surrendered. Okay, now sometimes I'll get students say, well, I didn't do it that way and I still got the right answer. So is that okay? And my answer is, I don't know. This is how I do it. If you've got some other way that you came up with of coming up with the right answer, I'm not going to argue with you. I like to do it this way, guys, because it always gets me to where I am, very consistent in getting the answer for the new equipment. Okay, so book value of assets surrendered. The book value of the equipment was 355. Book value of assets surrendered plus any gain or minus any loss. Has to be one or the other. It can't be a gain and a loss. 355. The cash, the book value of the cash we gave up was 40. Okay, and then we took a loss of 55. When I do it that way, I every single time get the right answer for the value of the new equipment. And so that's how I'm going to do it, okay? Till I'll be sitting on a park bench here in a few years when I'm retired and old, and people will say to me, what's your name? And I'll say, I don't know what my name is, but I know that the book value, record the new asset at the book value of the asset surrendered plus the gain or minus the loss. Okay, that'll be the last thing in my memory to go. Okay, all right, good. Okay, so again, just going back to the test-taking technique aspect here, I guess this answer here, I'm trying to circle that, not this part, okay, right here, A was the right answer, and you kind of see how you don't have to sit there necessarily and go through every single step to be able to answer a question like this. You had to credit cash, you had to debit a loss, and you knew you had to take the old equipment off at what you originally purchased it for, and that was enough to be able to answer this question. You didn't have to know the cash. I think they credited cash in every single one of these. So, no, one of them they debited cash. So that would have blown C out of the water. I think I gave C a chance. The answer is A here. I think I gave C a chance there for a second, not realizing that they debited cash. If you paid cash, you got credited. So I didn't have to do any of this. All I had to do was see which answers had the loss debited and then realize that they debited cash instead of crediting it for cash that was paid, and I was done. Okay, good. Let's go ahead here and look at question 8. Okay, and they give me a couple of cases. Okay, and so if they give you a couple of different cases, and then they ask you what's going on with case 1, that means you only pay attention to case 1 here to be able to answer this, okay? So they sit here and they say that Glenn Company and below's information of assets by Stanton Company. The exchange lacks commercial substance. What should Stanton record? And so since the transaction lacks commercial substance, I know that I'm not going to take any gains. I know that, right? If you lack commercial substance, what happens? I take that back. Messed up my rule. Stop. Let's retake that. Okay, what happens? If the transaction lacks commercial substance, right? And what? And I'm not, and the cash constitutes more than 25% of the total consideration, then I'll take the gain. If it's less than 25% of the total consideration and I didn't receive cash, I take no gain on that. That's what I wanted to say, okay? So they tell me that cash was paid. So cash is paid, I need to do a quick little calculation here to see, well, how much does that cash constitute of the total consideration, right? So they paid $90,000 cash. I have that in the numerator. In the denominator, I have that $90,000 cash. Plus what? Plus the fair value of the equipment that was given up, which is $510,000. So that gives me what? 90,000 divided by, what's that? 600,000? 90,000 divided by 600,000 is 15%. That's less than 25%. So I know that Stanton here will not take any gain because what? Because they didn't receive cash and the total consideration was less than 25%. So I'm done with this question, right? Just by that, by realizing that rule, I'm done, okay? But they want to record the equipment and they say at 540. So book value of assets surrendered. They gave up the old equipment, which had a book value of $450. They gave up cash that has a book and fair value, right, of $90. Okay, cash's book value and fair value are exactly the same. That gives me the 540, which of course we already knew the answer was A. Okay. Okay, so let's go ahead and let's take a look now at number 9 here. Okay, so Glenn and Armstrong Company have an exchange with no commercial substance. Okay, now sometimes for me, half the battle in these questions is figuring out who I'm doing the accounting for, so it's not a bad idea to sneak down. I think you saw me staring at that one because who are we doing the accounting for here? And we're doing the accounting for Glenn here, okay? So they tell me that they want to know what we should record for the asset received. What's the amount we should record the asset received? So I start to look at that and I'm like, well, okay, that's the book value of the assets surrendered, right? And so, and plus any gain or minus any loss recognized. So I sit here and I have the book value of the equipment that Glenn, because that's what I'm doing the accounting for, Glenn gave up $72,000. Okay, it has a fair value of 90. The asset given up by Armstrong has a book value of 120, fair value of 114. Boot, which is the same as cash, right, is received by Armstrong. Well, that means that what? That means that our friends Glenn paid that cash. Okay, so that's the book value of the cash. If Armstrong received it, then Glenn must have paid it. Okay, so then I'm like, but is there any gain here? Well, the transaction has no commercial substance, right? So since the transaction has no commercial substance, I've got to see, since Glenn is paying cash, they didn't receive cash, I got to see, well, okay, does the total consideration constitute 25% or more? Then I will take the gain. I'll have to add that to get the right answer here. If it's less than 25%, I won't take any gain. So I go ahead and I say, well, the cash was 24. The fair value of all the consideration was the 24. Plus what? Plus the fair value of the machine or whatever it was that Glenn gave up. I guess it's the machine here. Okay, so 24,000 divided by what? 114. Okay, gives me 21%. Okay. 21%, I guess I'll write it down here since I'm not going to be able to squeeze it in very well there, equals 21% roughly. Okay, that's definitely below 25. So since Glenn was paying cash, I take no gain here because it's below the 25% threshold. And so I come up with what, 96,000, which is the amount the new machine would come on in. Okay, again, those rules keep coming up over and over and over again for us, right? Okay, good. Let's take a look at this number 10 here now. And this is basically a basket purchase where you purchase several assets together. And then the problem asks you, well, how much should be allocated to any one of the assets? And all you do is you add up the total of everything they bought. They bought all of this together, $10,200,000. And now they want to know, well, how much should we allocate to what? The trucks. Okay. So they go through, they give me all this, we do an appraisal, and then the question says, well, how much should you give to the trucks? Well, the trucks are what? $3,400,000. We divide that by the total, $10,200,000. That's going to give me roughly 33%. Okay, about a third. Okay, and so then what? Then it's easy. Then you take the purchase price. Okay, and they purchase all this stuff for $5,600,000. Okay, and what happens? You take this $5,600,000 times what? Times 0.33, and that means the value that's assigned to the trucks is $1,866,667, and that gives us what? That gives us choice A. Okay, all right, and again, these appraised values are what you use, and you know, appraisers can come in with all kinds of different amounts and the way they look at these things. They have different methods. We're accountants. We go by, hey, what did we pay and how are we going to allocate that, what we paid to these different assets in this basket purchase. And they purchase it, I get it at auction or something like that. And so they're going to go ahead and do these allocations this way. Okay. All right. Not too tough. Okay, good. Let's go ahead and let's take a look at number 11. Down here, this Horner Company, okay? And Horner Company buys a delivery van with a list price of $70,000. The dealer grants a 15% reduction in list price and an additional 2% cash discount on the net price. If the payment is made in 30 days, so we'll get 2% if the payment is made in 30 days. Sales taxes amount to $930. The company pays an extra $700 for a special device installed. What should be recorded cost of the van? You know, what I don't like about this question is they have me starting to do all kinds of guesswork. Well, let's see. Was the whatever they had to pay, $700, was that installed by the dealer? And did the dealer give them a discount, the 15% and the 2% on that? And they have me, you know, starting to guess all kinds of things in this question. And I don't care for that, because if I'm actually doing this in a company, I know where the discount was applied in that. Okay, so they're kind of throwing the baby out with the bathwater in this question. Okay, and that the key takeaways are what? You record the asset net of any trade discounts that they're giving you, this 15%. Record the value net of any cash discounts that are given on this. And what? Sales taxes and any amounts that you have installed for a special device, whether discounted or not, are part of the cost of that asset. Okay, so we know all these things, but I don't know where they applied the discount, where they didn't. That's what gets me a little bit irritated here. So you kind of have to start doing trial and error with this question, and I do not like that. So I would make it clear to you on exam where the discounts were applied and whatnot, because an accountant would know that if you were asked to account for this transaction. Okay, so the way this problem worked is they had the $70,000, that was the list price. They got the 15% discount, so they're going to pay 0.85 of that 70,000, or they're going to get charged that. If you take that 70,000 times the 0.85, you get what? You get 59,500. And then I have to, again, the problem should make it clear that they took the discount. Okay, I don't know. Did they pay it in 60 days? I don't know. The problem doesn't tell me. Sorry, guys. I just get irritated with questions. It's vague like this. But, okay, calm down. Okay, they did take the discount. Okay, so now, and you would know that if you're the accountant. You wouldn't have to guess whether or not they took the discount. You would know that 59,500 times 0.98 gives me now 58,310. Okay. Now look, a dealer is not going to give you a discount on the sales tax. Okay, they don't have that ability. They're not going to pay the sales tax for you in most cases. And so if the sales tax amounted to $930, I know I got to pick that up. Okay, the $930, and then it turns out, I guess they went to some separate device installer. I don't know, and they installed the device, okay, and there was no discount on the device, so I have to add the 700 to that. 58,310 plus 930 plus 7 gives me now 59,940, the correct answer to this question. But I'll tell you, I don't like a question that's got me guessing, okay, but that's the way that would work. Okay, good. Now you come over to this next one, number 12, okay, and number 12 here is asking me what journal entry should I make when I give up an investment that I had in the stock. Let's read the question, guys. Siegel Company exchanged 3,000 shares of Gwynn Company common stock, which Siegel was holding as an investment, for equipment from Mayo Company. So I hold the stock of one company. I'm going to give that stock of that company to another company in exchange for some equipment. So I'm giving up what? My investment. This is not equipment for equipment. This is a financial investment that I'm giving up, and I'm giving that up for the equipment here, okay? So I'm going to value that on what? On the fair value of the investment that I'm giving up. Conceivably, I could go and sell that stock for the cash and get the cash back on that, okay? So this is not a non-monetary exchange as much as it is giving up a financial asset like an investment, which is as good as cash, and I'm giving up that investment in exchange for this asset, okay? So what happens? I'm holding the investment for equipment from Mayo, the Gwynn Company common stock, which had been purchased for $50 a share and has a quoted market price of $58 a share. Okay, when I see that, I know what to do. $58 per share times the 3,000 shares. I do my math. 3,000 times 58 is 174,000. I know that they have to bring in that new equipment for that amount. It is as though they paid cash. Think about it. If the investment has a quoted market share of $58 per share, I could go and sell the stock, get the cash, and take the cash and buy the equipment. I just bypassed turning that investment into cash and just gave them the stock directly. So I know that that's the right answer, and I don't have to do anything else here if I don't want to at this point. But just to finish up the thought process here, they bought the stock, the 3,000 shares, for what? For $50 per share. So 3,000 times what? Times the $50 would be this 150,000, obviously. And then in a situation like this is not a non-monetary exchange. This is giving up a monetary asset like stock for what? For the equipment. Okay, so now I sit here and I just have to figure the gain on this, which is the what? The 150,000 original cost of the asset versus the fair market value of the asset is 174. That difference equals what? Equals the 24,000. Okay, but you knew that as soon as you got the equipment. You value it at the value of the stock that you gave up in this transaction. Okay, all right, I'm going to go ahead and take a quick pause, guys, and we will come back and we will finish this thing up here. Okay, guys, let's go ahead and let's wrap this up with these last few questions. We've got about 15 questions on this particular one. Now, 13, again, when I'm picking questions for the practice midterm, I'm not always as discriminatory as I should be on it, discriminate as I should be to try to figure out what the best questions are. If I had to do it over again, I wouldn't give you this 13 because I don't like questions that make you squeeze out a number that an accountant would definitely know. Okay, now in this particular question, the first one, and we're going to have two that leverage off this same fact pattern, 13 and 14, they asked me the gain. Okay, now what I have to figure out in order to figure the gain is I have to figure out, well, the fair value I know is going to be more than the book value. I know that if they're telling me there's a gain, right? Okay. And so then I have to look, and they tell me that a machine cost 1.2, had annual depreciation of 2, accumulated depreciation of 950 on December 31st, 2020. On April 1st, 2021, when the machine had a fair value of 275, it is exchanged for a machine with a fair value of $1,350,000, and the proper amount of cash is paid. Again, this problem is going to make me figure out the cash here, which is a little annoying because if there's anything an accountant's going to know is how much cash got paid for something, right? And the exchange has commercial substance. Okay, so I'm looking at that and say, well, transaction has commercial substance. I know I'm going to take the gain here, and they tell me what is the gain. So I look at the fair value, and fair value is 275. Okay, now here's where this question really makes me mad, because they, in effect, give me the information to figure out what the depreciation would be up to the date that they sell it, because they tell me the annual amount of depreciation is $200,000, and they tell me that it had $200,000. I could figure out the depreciation per month by taking $200,000 divided by 12 and depreciate it up to April 1st. But when you do that, you don't get the right answer. So you have to go through that stupid exercise to find out that that's not one of the choices they give you, to realize, well, I guess then I better just take whatever the accumulated depreciation was, at the end of the year before the sale, to figure out the right answer here, which you shouldn't have to do that, okay? But that's what they did here. They took the $1,200,000 original cost, and they subtracted the depreciation of $950, okay? And when they did that, they got $250,000. Right? And 275,000 minus 250 means my what? My gain here, because my fair value is more than my book value, my gain is 25,000, which is the right answer. But damn, I had to first sit there and do it correctly, which was take depreciation up to the date of the disposal, when they got rid of the equipment, to realize that wasn't one of the choices that didn't back into the only other option, which was 25,000. I just don't like questions that do that. Okay, now let's just go ahead though, and let's keep messing with this thing, and let's see if we can figure out the whole journal entry. So we know already we're going to have a credit to a gain of 25,000. I'm not going to write that down right now. Okay, and then what are we going to do then? Okay, let's see, this thing doesn't want to turn blue on me. Okay, and then we're going to go ahead, and I think I'm going to calculate, because they say the proper amount of cash was paid. Well, why wouldn't I know what the proper amount of cash is? But they're going to go ahead and make me calculate that. So what would be the proper amount of cash that would have to be paid here? Well, I have what? I have this 250,000 of book value that's coming out, but I have what? I have the machine has a fair value of 1,350,000. That's the one I'm getting. And I'm giving to them something that has a fair value of 275,000. That's for the old machine. I'll put an N here and an O here, new and old, of 275,000. So what happens? I got a machine that's worth 275,000. I said, here, take it. Give me your machine worth 1,375,000. 1,300,000 and make sure I got the right number. 1,350,000. And you're going to sit there and you're going to say, hello, who do you think I am? If you want this machine for 1,350,000, all you got is that hunk of junk that I'd say is worth 275. You need to make up the difference to me, pal. And so what's going to happen? I'm going to have to pay you out cash of 1,075,000, right? That's the cash I'm going to have to pay you. Okay, so we've got the gain, we've got the cash. Okay, so then the only other question is, well, what's the book value of the new equipment? Okay, and the book value of the new equipment, just give myself a little more room down here. The book value of the new equipment is going to be the book value of the assets surrendered plus what? Plus any gain. So now when I go ahead and I figure out the cash, it's what? It's the book value of the equipment that I gave up, the old equipment, 250, right? It's the what? It's the cash, which I just calculated, 1,075,000, right? And it's the gain, right? Plus the gain. The gain was 25,000. And when I add all that up, that means that I should bring on that new equipment at, and when I do the math of that, I get the new, the 1,350,000. And again, just sitting there, trying to be consistent in how I come up with the answer for these, okay? Because I do that book value thing every single time. So now I can do the whole journal entry, which is what? I debit the new machine. Okay, new machine is going to get debited for 1,350,000, right? I have to go ahead and debit, although I don't agree with the way they did the accumulated depreciation, but that's okay. It's their book, okay, 950. So I debit the accumulated depreciation, 950,000, right? And then what? Then I go ahead and the old equipment, right? Take that off at 1,200,000. I'm getting rid of that, getting rid of the accumulated depreciation, rid of that, getting rid of it. I go ahead and I do what? I credit the gain for 1,075,000. I credit the gain for 25,000. Okay, and then I go ahead and I credit the cash, which I just figured out a minute ago, for 1,075,000. Okay, and you can put together the whole journal entry that way. Now this question just asks you basically pieces of the journal entry, and you didn't have to do the whole journal entry to answer this, but you can see that we can go ahead and get the answer to the next one, the new machine should be recorded at the 1,350,000. Okay? Okay, good. Let's go ahead then and let's take a quick pause, and we're going to work out these last this last problem. In fact, what I'm going to do, guys, is take a pause and we'll do this last question. Okay, guys, let's go ahead and wrap up our practice midterm for chapter 10 with this last question. And again, this is one of those questions, knowing what cost, more like we looked at towards the beginning of the discussion here. Do you know how to gather cost in the calculation, in this case, of the land? Okay, that's what we're looking for here. So they tell me that they purchased the land for $780. I know I got to pick that up. Okay, the old building on the property was raised, salvage materials resulting from the demolition were sold, and then they give me some additional cost. Okay, so the cost to take off that old building, raised, meaning they tore it down, $70,000. Legal fees to purchase, contract, and to record ownership. Yeah, you got to record the title with the county, whatever. You got to sit there and bring that cost in. The title guarantee insurance, right? In case there's a lien or something that the title company doesn't find out about. These are all. Sorry, guys, my commas sometimes look like ones. Okay, is $16,000, and then okay, good. They sold some of that scrap for those priceless doors for $8,000. You go ahead, you do the math on that. That's 868,000. Okay, that's choice C. All right, so not too bad. A couple of these questions, I'm not a fan of ambiguity on questions and making you do trial and error to get the right answer on these questions. So some of these that have that, don't worry about that on your actual midterm. I'm going to give you the pieces and just expect you to follow the processes that we've talked about to be able to answer these. Okay? All right, guys. At this point now, you have the lectures for chapter 10 and 11. You have the slides, the lectures. You have the practice midterms. You have the lectures for the practice midterms. And then I'm going to also post the marked up version of this so you can kind of have that to look back and see how I answered some of these. Okay? All right, guys, that's week 1 and week 2. Make sure that you are getting in and practicing a little bit with that homework so that you can get those homework points. You need to acquire the book if you don't have it with Wiley Plus, so you can go in and look at those homeworks. And then you need to play with the homework a little bit, just so I can see that you've made some progress in looking at that. I'm not going to be real strict on how I grade that, so just make sure, spend some time with that homework. Your key tools for preparing for the exam and getting a good grade in this class, again, are the slides, the lectures, the practice midterms, the lectures with those, and that should be the best way for you to study. Okay? All right, guys. I will see you soon. Take care. Have a good rest of the week.